I'm Mark Zandi. I'm the chief economist of Moody's Analytics. I don't know that we're at bottom. I think there's more to go, but I think the bottom is in sight, which is it's a relief. If you go back not too long ago, widespread expectations were that we were going into a recession, and we've avoided that. And it looks like we'll continue to do that with a little bit of luck and some reasonably good policy making. And interest rates look like they've peaked. It feels like that's kind of where it's going to settle. And the Fed's pretty close to lowering interest rates. So I think that kind of macroeconomic backdrop just feels a lot better than where we were 6 months ago. And I think that probably is what the mood reflects. I think we're not through with the price declines. There aren't a lot of transactions in the marketplace, so we're not really quite there yet. But I do think we're getting to a place where that's going to start happening. Probably see some more price declines, particularly in the office market. We're getting closer to viewing the end of the price declines. But what the price declines means there's going to be some default, some increase in default. You can kind of feel it already. Delinquency rates on commercial loans are on the rise, and there'll be more defaults and some distressed sales. There is still the reasonable concern, risk that the problem is metastasized, and the defaults undermine lenders, the banking system. Banks have to pull back, and you get into this kind of self-reinforcing vicious negative cycle, the so-called kind of doom loop that has been on people's minds. So I don't know that we can dismiss that yet, but I think it feels a lot less threatening, that potential risk, than was the case just a few months ago. But there's still, we're not through this yet. We still got more work to do. The office market, downtown office, big urban centers, the DC, New York, my hometown of Philly, Chicago, San Francisco, LA, Seattle, those are the areas where that's the market that's under the most pressure. And the fundamental issue is that people didn't come back to work after the pandemic. Most markets that I just mentioned were, a third below what we were pre-pandemic, and that's kind of leveled off. So that means there's just less need for space. Vacancies rates start to rise, it put downward pressure on rent and on prices. And that's, you will get more defaults, here going forward. So the real worry would be then if those defaults resulted in distressed sales that push prices down even further. And again, that's a risk in the office market in those big downtown urban areas. But I don't think outside of that, we're likely to see that, to the degree that it becomes a larger, broader macroeconomic problem. It's a threat, it's a risk, but I don't think that's the most likely scenario. The banks who've made the loans default, it undermines their capital position. Depositors lose faith in the bank and start leaving the bank. Investors in the bank, equity holders start to sell stock, and you get into a self-reinforcing cycle. For the large banks, the banks that are so-called systemically important, that if they go down, the government's going to have to step in and bail them out. Therefore, that means that the big guys, in my view, are going to be able to navigate through this without, significant a problem. It's certainly not an existential threat. Now, the smaller banks, the mid-sized banks, there the exposure is a lot higher, and we could see more. In fact, I would be surprised if we don't see more bank failure. But these are small institutions and should not be systemic. They should not generate a deposit run, the kind of thing that causes the banking system to go under. It's a worry, it's a concern, but the logic would dictate that that this worry or concern isn't going to become a reality. The economy's been amazingly resilient. Consumers have hung tough and done their part and continue to spend. It's hard to see the economy going in a untoward direction, and therefore the CRE market should, it's not going to be fun over the next year or two, but it's not going to be a disaster.